We'll be using indicators in this session. In this video, we'll explore two distinct strategies. The first strategy will rely on indicators along with a trend filter. In the second strategy, we'll integrate price action and candlestick patterns. Let's dive in, but before we proceed, if you find this content valuable, hit that like button. And if you're new to the channel, make sure to subscribe and enable notifications so you never miss our latest updates. I'll catch you right after the intro and disclaimer. Stochastic is a widely used indicator among traders because it can be applied in multiple ways. It functions as a momentum indicator, and at the same time, it helps identify reversals using overbought and oversold levels. You probably know there's another indicator that shows overbought and oversold conditions, which is the RSI. So, what makes stochastic more effective? First, if you compare the two, you'll notice that the stochastic indicator moves clearly around the midpoint between overbought and oversold levels, whereas the RSI sometimes moves sideways within those zones. The stochastic indicator has two lines, the %K line and the %D line. These lines provide extra signals. With RSI, we cannot reliably predict the market direction, but using stochastic, we can anticipate whether the market may go up or down. When the %K line crosses the %D line from above, it signals a potential downward move, and when the %K line crosses the %D line from below, it signals a possible upward move. These are some reasons traders favor stochastic. So, how do we trade using stochastic? A common beginner mistake is buying whenever stochastic hits the oversold zone and selling whenever it hits overbought. This approach is flawed because in a strong trend, stochastic can stay in overbought or oversold regions for a prolonged period. Here's the proper method. First, combine the 200 EMA with stochastic to trade in the direction of the trend. If the price is above the 200 EMA and stochastic is oversold, we look to buy. If the price is below the 200 EMA and stochastic is overbought, we look to short. However, trades shouldn't be executed solely based on oversold or overbought levels. We need confirmation. Wait until the indicator crosses the oversold or overbought threshold and moves beyond it. Let's look at some examples. Here, the price or candle is above the 200 EMA, which indicates that we should only focus on buy signals. Next, notice that the stochastic is currently in the oversold zone, but we shouldn't enter a trade right away. We wait until it crosses the oversold level and starts moving upward, then we can take the trade. The stop loss is placed above or below accordingly, and the profit target is set at double the stop loss. Now, our target becomes clear. Let's examine another case. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. When the price is below the 200 EMA, we search for short opportunities. Even if stochastic is overbought, we don't enter immediately. We wait to see if stochastic crosses below the level. Then, we take the short trade with a stop loss set appropriately and the profit target at double the stop loss. Next, let's explore another strategy, combining stochastic with basic tools like support, resistance, and trend lines. In a trending market, we can draw a trend line like this. Observe the pattern. Whenever the price rises, stochastic reaches a certain level and the market reverses. This happens repeatedly. Now the pattern is forming again, and the price may stay around this level. At the same time, the stochastic is in the oversold zone, but we need to wait for it to break that level and start moving upward. Now you can see the stochastic has crossed above the oversold level, and we also have a bullish pin bar, which provides an early signal. This is the point where we can enter a buy trade. For example, the price has touched a particular level multiple times and been rejected. We can mark a resistance level here, and similarly, another resistance level here. The pattern shows that whenever the price approaches resistance, Stochastic is overbought, followed by a downward move. Currently, the price is near all resistance levels, and Stochastic is also overbought. We wait for confirmation. If Stochastic crosses down from the overbought level, we take a short trade. Multiple rejections at resistance support this setup. Similarly, when spotting a support level and Stochastic is oversold, we wait. Once Stochastic breaks the oversold level and moves down, we can take a short trade. Let's examine another example. Here, you can see a support level. Whenever the price approaches this support, the Stochastic is also in the oversold zone, and then the market reverses. Now, the current price is at the support level, with the Stochastic also in the oversold zone. We need to wait. Once the Stochastic breaks the oversold level and moves upward, we can enter a buy trade here. That's it, traders. Thanks for watching this video. Winners don't announce what they plan, they take action. If this video inspired you to stay focused and keep progressing, hit that like button, and if you're new here, subscribe and turn on notifications so you never miss an update. Every video is made to help you maintain momentum and stay in the right mindset. Keep believing, keep taking action, and don't look back. I'll see you in the next one.